Hello traders, welcome to High Fund Forex. This is Regan. My name is Regan, and I'm here to elevate your trading skills. I'm here to take you from the majority, from the 90% who don't make money, and I want to take you to elevate your trading skills to the 10% who are only profitable in the long run. In a matter of time, you're going to discuss about a 200 exponential moving average. It is a custom indicator which has been around for quite a while, but there are very many ways. There are several ways you can utilize it according to your information. Me here in High Fund Forex, we utilize the 200 exponential moving average in a very different way. We use it in our trading system, and there are 5 ways you can utilize, you can use the 200 exponential moving average to elevate your profitability, to strengthen your potential as a trader to collect a lot of money in this market. The first way, there are 5 ways you can utilize the exponential moving average, and one of them is the consolidation, is identifying consolidation in the market. As a trader, you do not need to trade during the consolidation. Consolidation increases risk. You hype as a trader in the forex market. A beta stock trader, a beta crypto trader. As a trader, you need to identify the time when the market is trending and the time when the market is consolidating. You cannot perfectly determine when it is all starting, but at least you can be identified and have a signal in one of the two is starting, either a trend, bullish or bearish, or either a ranging market which is consolidating, or it can be a whipsaw. Let's go down to the H1 time frame, USD JPY, and we see how we can utilize the 200 exponential moving average to identify consolidation ranges, whipsaws in the market. This is USD JPY chart. If you look closely here, price has been creating pullbacks into this 200 moving average, which is the green, whereas the red is the 50 moving average. The 200 moving average, which is the green, price has been pulling into the 200 moving average over here. This was a pullback. Price pulled back again, then price passed below it, then price continued to play around the 200 moving average. This was due to some recent news. Price pulled back into the 200 moving average, which identifies a consolidation environment in the market. As of a trader who are looking to identify a trend, my advice always to identify a trend. As a trader who's looking to trade in a trending market, you do not need to trade during this. You do not need to trade during these whipsaws over here. This is a ranging market. This was a ranging market due to some impactful moves, which responded to some strong fundamentals that affected both the USD and the Japanese yen as well. Let's continue to further examples. This was very mean, but price was playing around the exponential moving average. You don't need to trade during this area. You do not need to trade during that area. Let's continue again. Price continued, and then further I was moving through the 200 moving average. You do not open up a trade during this area here. Let's go ahead and continue. Let's go ahead and look at we look for further more example. If we look closely again, price was playing around the 200 moving average, creating whipsaws all over. As a trader, you don't need to trade during this area here. This area is very deadly for a trader, as of many traders who are the 90% of them who lose money. This market tend to trade during the whipsaws. As of a trader, you need to identify the whipsaws to be out of the market, and then this gives you the right time when you are out and then when you are in the market. Not trading is part of the system. As of a trader, it's okay not to trade at all. It is okay. This is another example here. Price was creating a whipsaw, created a strong pullback here, pullback there, ended up consolidating and then creating ranges, whipsaws, this which are not friendly at all. Let's go ahead and continue. Good. This is the current situation. This is the current situation in USD JPY. As of last week, we analyzed the USD JPY, and my advice, according to my technical analysis, the system was saying you should be out of the market because the USD JPY was ranging, creating all these pullbacks here into the exponential moving average, identifies a consolidation ranging, a consolidation market. And as of a trend following system, you need to be out of this market. It's not good for anywhere else. Even if you trade with SMT, SMC, support and resistance, all this choppy environment is not friendly to any trading system. It will end up giving back the money to the market. And our motto here is to reduce losses so that you elevate the profits as well. By eliminating trading in the consolidation, you elevate your earning skill. Let's go to the reason number 2. The key factor number 2 is volume. By the use of the 200 exponential moving average, you can identify volume. Every trading system, whether you trade price action, whether you trade SMT, SMC, they all have different names, but they come up to technical analysis, which is price action. All those technical analysis, the technical strategies, they all need volume in place. They all need volume in place. As of a trader, you need to apply volume. You need to identify volume. You need to identify volume. Volume creates an environment which is favorable to your trading strategy. Let's go back. Let's go back down to the USD JPY chart. A USD JPY chart. It's an H1 time frame. It's an H1 time frame. Remember, I always advise you backtest your systems on USD and Japanese pairs. As of they are very liquid. They are very liquid. They are very many. They are very liquid. You should create your strategy and then backtest your systems on USD pairs and then yen pairs. We are on USD JPY currency pair. If you can identify here, if you can see, price was creating pullbacks, and none of these pullbacks touch the 200 exponential moving average, which is the green. The green is the 200 exponential moving average. None of these pullbacks was touching the 200 exponential moving average. Identifying volume in the market. Identify clear volume. Identifies clear volume implies to clear trend. Clear volume identifies to clear trend. When there is volume, price is more likely, the chances are very high that price is going to trend in one of the directions, either bearish, either bullish. If we can look closely here, price has been creating pullbacks, impulse movements, but price was none of the pullbacks was touching the 200 moving average, which is the green in color. Pullback 1, pullback 2, pullback 3, pullback 4, 5, 6, and etc. Let's continue. This is very clear over here. Price was trending bearish. This is a very established downtrend, creating pullbacks, but none of them was touching the 200 exponential moving average, implying there is volume in the market. And as of a trader, this is where you need to come in and then utilize the opportunities as price establishes them. This is pullback 1 over here. Sorry, this is pullback 1 here. Pullback 1, 2, 3, and then 4. Then price continued to rally down. Price continued to rally down until price touched the 200 exponential moving average. Here, all this implies volume in the market. All this here implies volume in the market. As of a trader this year, this is where I need to come in and then utilize the opportunities established in such a kind of trading environment, which seems friendly when there is volume in the market. Let's continue to another example, to another clear example. As of see around here, Price is far away from the 200 moving average, which is in green in color, which implied strength in the trend, strength in the volume. There is volume in this area here. You need to come up and then utilize opportunity here. And let's go to number 3, the end of a pullback. Many traders out there, more likely beginners, you might be wondering, where should I catch the trend from? Where should I put my emphasis from when price is pulling back? When the price is pulling back, one of the key things you need to identify to identify the end of a pullback is by utilizing the moving average. It is very dynamic. It is a very dynamic indicator, which implies that it can follow price tightly to signalize what you need as a trader. And one of them is identifying end of a pullback. Let's go back to the USD JPY chart. Still H1 time frame. Still it's a H1 time frame. As we can see here, this is a very clear example here. Price rejected off the 200 moving average. Price rejected off the 2 moving average. Let me zoom in. Price rejected off the 2 moving average over here with a strong spike, of a bearish candle. But then later on, it was followed by a strong bullish candle, a strong bearish candle, green in color, which implies a reverse or end of this pullback. That's a second confluence. First confluence, price is trending up. First confluence, price is trending up. Second confluence, price is rejecting the 200 exponential moving average, green in color. Then third confluence, bullish candle, green in color, which closed above the recent bearish candle. Here you make an entry here, and then stop loss below the pullback. Target 1 to 2 to make sure you monitor your win rate. The higher the risk to reward ratio, the higher the reward, the stronger the losing streak. The lower the reward, the lower the target, the descent in the losing streak. Therefore, you need to monitor your risk to reward ratio as a trader. Let's continue to confluence to another confluence here. Let's continue. Let's continue. This is an uptrend. This is an upward trend here. This is an exponential moving. This is an exponential EMA in color. Price pulled back strongly off the 200 EMA. The 200 EMA over here. Over here, it pulled off perfectly, followed by another confluence, followed by another confluence here. Oh, sorry. Price pulled back off the 200 moving EMA, which is green in color, indicating if you add another confluence, which is a bearish candle, over here, closed above the recent bearish candle, this bullish candle, green in color. We don't trade reversals here. We follow trend. After identifying the end of the pullback, we need a second confluence. You can add off a stochastic, and you can go to the lower time frame for more criteria to make sure you add confluence to your entry. For instance, here price is pulling back. This bullish candle here, establishing huge volume on a lower time frame. It's a nice signal, another second confluence that you can enter the market here. You go bullish. This the entire trend is bullish. So entry here, stop loss below, target 1 to 2. Let's continue to another example. There's another example over here. Price pulled off perfectly off the 200 moving EMA, followed by a bearish candle, in place, to add to confluence and then make a clear perfect entry. Price pulled back. We were bearish here because the entire trend The entire trend is down. We follow the trend. My advice is not to catch reversals at all. Reversals are not good at all, not anywhere. Following a trend is a key here. Following a trade is a key here. Following trade is a key here. Always advise my fellow traders, my followers to follow the trend. Following a trend is a good thing you can do to put the odds in your favor. As of now, a price pulled back and then rejected off the 200 exponential moving average, followed by confluence number 2, which is a bearish candle. The first bearish candle was a bit weak, but if you are firm enough, you can wait for a second confirmation, which is another bearish candle as well. Entry here, stop loss above, target 1 to 2. Don't fight for higher rewards, for higher targets, as of they lead to strong losing streaks to the trading system, and which can hurt you psychologically, and you may not be, you will be prone to that. So utility number 4, reversals in the market. The 200 exponential moving average can be used to identify reversals in the trend. If the market is trending strongly, whether the marketing environment is bullish or bearish, one of the key things you need to look for as a trader to identify reversal is either consolidation or strong pullbacks. When the trend is very strong, price will always establish weak pullbacks. And when the trend is very weak, price will always establish strong pullbacks. Let's go down to the USD JPY chart, and with how we can utilize the exponential moving averages, the 200, how we can utilize it to identify reversals in the market. Let's go back. USD JPY over here. USD JPY, we are testing our systems on USD JPY because it's a very tricky pair to ensure that our system is in place. If you look closely over here, before price was trending, created a short-term trend, but as the short-term trend was soon to stop, price touched the 200 EMA over here. This is the 200 EMA in green in the color. Price touched it first, and then price touched it again the second time, which indicates that the trend is reducing in strength. You need to pull out and then take a step back. As the price continued, it rallied down below here. And it continued creating whipsaws around the exponential moving average, indicating the weakness in the trend, and then indicating the weakness in the trend, and then reversals in the trend as well. And then as you see here, this was due to some fundamentals which are very strong. It impacted the dollar and then the yen as well, leading to all this choppiness around here. As of a trader, you don't need to trade. There's no money you can make long term trading during whipsaws, trading during a consolidation. You always give back that money that you always make during the news, and then during consolidation you need to be out of the market when there are strong whipsaws, and then you be in the market when price closes trending. Let's go ahead and look for other examples. As you can see here, before price changed direction to bearish, this was a very clear, well established upward trend, but before price reversed, one of the first indications we got was the touch on the 200 exponential moving average. The first touch, then the second touch, the first touch here, the second touch, and then the third touch, indicating that price is soon reversing, changing direction, or a sign of consolidation. Here you need to be out. It's encouraged as a trader that you change your bias because price is touching the exponential moving average, is the 200. Let's continue. Price touched the 200. Price touched the 200 here first before it reversed, creating all these lower lows in the downward trend. Let's look for a further example. As you see here, this trend, which was bearish, as it weakened slowly up, it touched the exponential moving average. The exponential moving average is the 200. Started ranging. price started ranging in this area here, up and down through the exponential moving average, indicating a reversal in this market, indicating a reversal in the direction of the market, indicating a stop of this entire bearish trend. As of a trader, you need to change your buys, minimize on the risk, and then stop, and then you wait for another bias, another time when your system aligns up all together. Number five, the way you can utilize the power of the exponential moving average, you can use it to measure the strength in currency. And many traders out there trade different currency pairs. Some trade 1, some trade 2, some trade 3, some trade 4. But as of my advice, if you are trading on a lower time frame, I mean minutes time frames. If you're trading minutes time frame, I always advise to stick to one currency pair, because the lower you go in a time frame, the harder it is for you as a trader to trade. And then the higher you go, the more you put your odds in favor. That's why as you go on higher time frames, H1, H4, daily time frame, weekly time frame, as there you can increase your currency pairs. But as you're trading several currency pairs, sometimes you find yourself in a dilemma. Which currency pair you need to put on a trade, whether you put 2% on USD JPY, whether you put 2% on pound yen, whether you put 2% on the dollar. You can utilize the exponential moving average to manage that strength in the currency pairs. Let's go down to the time frame, and then we see how you can utilize that. Let's go to the USD JPY currency pair. As you can see, recently in our weekly technical analysis, we do weekly technical analysis recently. The USD Japanese yen was ranging up and down through the exponential moving average, creating these whipsaws, creating consolidation. As of the things we have recently mentioned, this indicates that the strength in the currency pair of USD JPY is very weak. We should put our hands off and then look for another currency pair to put on the watch list. Here you go away. If you want to go ahead and trade the dollar, if you go ahead and you want to trade the dollar or the Japanese yen, you can go into another currency pair which involves the Japanese yen. Let's go to pound JPY. As of pound JPY, it has been creating decent lows in this clear descent trend. It is trending. It is trending clearly. You go pullback 1, pullback 2, pullback 3, pullback 4, pullback 5. As of it's creating a pullback here. So you can put JPY, GBP, JPY, the pound JPY on your watch list, other than trading all these whipsaws, which are going to chop off your money and then create a strong resist streak your account can never sustain. Okay, let's say you want to insist and you want to trade the USD. You can go ahead and neglect the USD JPY and look for USD in another currency pair. Let's go and look out for the GBP USD, which is the cable. If you can see GBP USD, it's clearly trending, establishing a clear trend. Price is trending far away from the exponential moving average, indicating volume. Pullbacks are not touching the EMA, indicating strength in the trend. All that confluence helps you to put the watch list on the pound dollar. As of if you can see clearly, let me mark the lows and highs. These pullbacks here, pullback 1, pullback 2, it's creating pullback 3 here. This is a very clear, nice trend. You need to put your money. This is the right place to put in your money. This is a very clear environment, other than trending in such a bad environment with whipsaws in the USD JPY. It was trading clearly of recent, but as we have said, when price starts to play around the exponential moving average, it's another indication, either consolidation, either weakness in the trend, either direction change, either whipsaw consolidation, and that helps us to identify what we should do next in that currency pair. So as of looking in another currency pair, which is pound USD, you would rather trade this, or would rather, if you want to trade the yen, you can trade this other than trading this. This is how you can use the exponential moving average to identify consolidation in the market, volume, end of pullback, reversal, and currency strength. I'm here to elevate your trading skill as a trader. I always emphasize you to put your psychology in place. Keep on subscribing. My name is Regan. This is High Fund Forex. Please like and subscribe. If you have any comments or any other question you would like, please comment down below. I hope your answer will be answered very soon. Happy trading. Don't forget to like and subscribe. Thank you.